It sounded crazy. I remember saying to people, we're going to build a bank. We're going to have no paper in the bank, not going to handle cash at all, no ATMs. And one person saying to me, it sounds like you're going to build something, but it's not a bank.
Neobanks are notoriously hard to make profitable. You've done that in just 5 years. I would love to talk about that.
We had to raise capital. Nobody was funding startups. I pitched to over 250 potential investors before I got the first yes. It's just brutal.
If we fast forward to where you are today, serving 17 million customers with Tyme Bank, where did this all begin?
If you believe there are 8 billion people on earth, there's somebody out there who's willing to be convinced by you. We had to find that Goldilocks zone, not too hot, not too cold, just right. That zone we could continue to attract capital to show that we could run a profitable business.
You're the fastest growing digital bank in South Africa, maybe even top 10 in the world. 500,000 new customers every month. 500,000 every month is a big deal in any context.
We know that 8 out of 10 digital banks will fail, but the 2 out of 10 that will make it will be very big and will be very profitable.
Talking of expansion, you started in South Africa. Now you're operating in Southeast Asia. So when companies think about expansion, they look to their neighbours. But what you've done is expand into Southeast Asia.
One of the things we do as we go to new countries is we try to find the best local partners. Not only people who have good retail distribution, but people who truly love and understand their customers, understanding the context in which those customers live.
Hi, Coen. I'm the founder of a FinTech startup. We raised over 30 million in total. We were on the classic high growth trajectory. Things were looking good. Then the market shifted. Welcome to another episode of the Startup Leap. Today we have Coen in the house, and we are going to hear all about how Coen and the team built an incredible digital bank in Africa, expanded to other emerging markets. Welcome, Coen.
Welcome.
Maria, Yvonne, lovely to be here with you.
So maybe just to kick things off, if we asked your team one word to describe Coen, what do you think they would say?
Irrepressible, unreasonable, crazy.
I love it. Irrepressible, unreasonable, crazy. Why do you say that?
For any of us to achieve anything against the odds requires a level of cheekiness in our ambition. And once you start along that route of being ambitious, that becomes part of your identity. And you have to keep going. What you realize is that to the extent that is sincere, to the extent that has integrity, people actually love it and they forgive you for it.
I love it.
Funny you say sincere, actually.
We did ask
your
them.
colleagues what they thought would be one word to describe you. And
Yes,
Charlene,
it.
your group chief global commercial officer, actually said sincere. She said strategic, dynamic, thoughtful, and stubborn in a good way.
So you were right. You were right. And an interesting one also came through. Rachel said Sisyphean, visionary, inspirational, deep thinker, loyal, and committed. Now, I had to go Google what Sisyphean means. And apparently it has a whole backstory.
The story of Sisyphus is an amazing story.
Yeah.
It's the story of this king punished by the gods, and he gets to roll a boulder up a hill every day. And every night that same boulder rolls down the hill, and tomorrow he has to roll the same boulder up the hill.
Wow.
And there's this crazy French-Algerian philosopher by the name of Albert Camus. And he says that life is absurd. It's really hard. And it's really unreasonable in its demands on us. But he says, imagine Sisyphus happy. Imagine a life where you can find meaning in the toughness of every day. And this is one of the things that the path teaches all of us in the startup world, is you start thinking of yourself more as Promethean. Prometheus is the guy who stole fire from the gods. And you think, I'm going to be brave, I'm going to do something transformative. But the reality is not like Prometheus, it's a once-off brave thing. The reality is that every day is hard.
Mundane.
And every day you have to believe that if I do this hard thing today, maybe tomorrow is easier.
This is so interesting because you didn't know that we were going to get your colleagues coming in. But I just wanted to highlight 2 other people who sent in some stuff. Carl, that's the CEO of Tyme Bank, he said driven and visionary. Also, David, who's the co-CEO of Tyme Group, said inspirational. But looking at what they've said, one of the things that come through, that resilient spirit cuts through very quickly, but then also says you're visionary, inspirational. So it is interesting that there's some alignment on what you think they would say, even though crazy wasn't quite there.
You caught me. But they're being very nice. I also drive them crazy. That's part of the job as well.
Yeah, it's part of the journey.
You know, the journey is about care for each other, loyalty to each other, but it's also very much about each other's growth and pushing each other hard. The startup world is a team sport. And a big part for me of the joy of the startup world is to see people unfold their true potential, to become even better people than they themselves imagined they could be.
I love that's the mark of a true leader.
And you've worn many hats. I guess if we fast forward to where you are today, serving 17 million customers with Tyme Bank, where did this all begin? What's the origin story?
And maybe for our audience, what is Tyme Bank? What is it? What does it do?
So Tyme Bank was born from a passion for financial inclusion. A bit of the backstory, my initial training was in law. My passion was human rights and jurisprudence, philosophy of law. And I have this personal passion about human potential, about seeing people become their best selves. And after democracy in South Africa in 1994, it became very clear to me that political emancipation does not necessarily lead to economic empowerment. So I became obsessed with this question: what can be done to change the rules of the economy to empower more people? And became convinced through reading writers like Hernando de Soto, the Peruvian economist, Jeffrey Sachs, and C.K. Prahlad, the Indian academic, that the key job here that we need to do, particularly as private sector players, is to give people the tools for participation in the economy. And by tools, we mean bank accounts, savings accounts, the ability to borrow money, the ability to use assets like a house or a car or a degree to get access to capital, this kind of thing. And that the job for our generation, or at least one of the big jobs for our generation, was to bring those tools to everyone at a price point that would work for them. I came to this insight in 2000, then spent 5 years convincing myself to leave my lucrative job in corporate and investment banking.
What was that trigger that made you take the leap?
I taught the subject of financial inclusion at the local business school in Johannesburg, and my students started shaming me into making the leap. They said, how can you, every year you come and teach us this class and you still go back to your job as a corporate lawyer? And I realized they were right, that if I was serious about this, I had to do it. So I resigned my job without having another job, realized that probably before I start my own business, I needed to learn banking. So I went to work for Standard Bank, reported to a guy by the name of Sim Shabalo, who taught me banking. He's now the CEO of Standard Bank in Africa. And then in 2012, we went out on our own. And that's a whole other story.
Wow. First, we have stories of founders who typically take the leap when there's not that much to lose technically. And when I say not that much to lose, almost that they're early in their career, they haven't built up that Rolodex of experience that could potentially be a path that they continue on. But you had done that. Like you had the law career. It was completely different from banking and finance. You went and worked somewhere just to get the experience, but then to start from scratch. And I know that Tyme's origin story has a backdrop of it being a consulting project. So I'd love to talk about how that all came about and how you decided, this is it. This is the thing I'm going to do now.
Yeah, I came reasonably late to the startup world. And I have to say, I'm not a natural founder. I enjoyed in my early career working with colleagues in quite established businesses. But a university friend of mine, who's my co-founder, he worked in his own startups all the way through. I was a seed investor in his startups. And in 2011, he had an exit that made us both quite a bit of money. And that was the cash that we needed and a little bit of the courage that I needed when he said to me, you've been talking about this now for a long time. It's time to do it. And a friend of ours was the CEO of Deloitte's Innovation and Strategy Division. And he said, listen, it's very difficult to convince big businesses to partner with you. From day one, we had this idea that digital banking would work best in partnership with retailers, mobile operators, and players like that. He said, it would be difficult for you to be taken seriously if the two of you pitch up on MTN or Pick n Pay's doorstep and say to them, let's build a bank together. Come into Deloitte, work with us, and let's see where it goes. And I joined Deloitte in October 2011 as a partner. The first project that we sold was this idea of building a bank at the time for MTN South Africa. And only 8 months after that, we spun out Tyme as a standalone business from Deloitte. Tyme originally was an acronym, Take Your Money Everywhere.
Oh, that was Tyme.
We thought the spice is interesting, but the idea was that we would help you make your money mobile. You don't have to have the cash in your pocket, have it on your phone, you can send it, you can receive it, and so on. Initially, we did it as a banking as a service business. And through a long story, we always believed that the right way to do it is to do full service digital banking under our own license. And we only really started that version of Tyme in 2019. So Tyme in its current form is actually only 6 years old.
Wow. It's interesting that you say that, because you mentioned that you wanted to be a full service digital bank. When you said that was like day one, impossible, or maybe hard at the very least, like starting, what was that evolution? Several founders sometimes see the vision so clearly, but when you now have to take steps that don't necessarily look like the big vision, they almost feel like they're trading off on something. They're like, no, that's not what I wanted to build. But life isn't like that all the time. And sometimes you have it all compressed in your mind. So you having to take those initial steps, what was that journey of a part solution, but not being the full vision, and that tension over the 7 years before it became what it was?
Also, just to add to that, what was it that gave you the conviction to go ahead and do it? Because today you have Nubank, you have Revolut, there are full service digital banks, but back then there really wasn't many at all. So just curious, what was it that just gave you that conviction to actually plow ahead and go ahead and build this?
Looking at the progression of digital banking today, it's fair to say that it was obvious, and that we weren't the only people who thought that was obvious. The technology wasn't quite there. The user behavioral patterns weren't quite there. The regulation wasn't quite.
Most definitely not, yeah.
But it was obvious that it needed to happen. And I can now say it was obvious because we didn't know the Nubank guys, the Revolut guys, the Monzo guys, the Bank Jago guys in Indonesia. But as we were plotting this in South Africa, other people were plotting the same ideas all over the world. And we all incredibly lucky. We could easily think of ourselves as being these unique visionaries. The truth of the matter is that idea's time had come. And it was just about good execution, resilience, hard work, and finding the right place and the right time to make it happen. And what we've seen in the last decade is that technology, user expectations and behavioral patterns, regulation have all come together to make this the right time for digital banking. I said last year at a conference in South Africa, they asked me to be the keynote speaker just to stir things up. It was all the CEOs of the big banks in the audience. And I said that in 10 years, the most profitable and largest retail banks in the world will all be digital banks.
Completely agree.
And even last year, I had a lot of people in the audience thinking I'm crazy. But for those of us closer to the digital banking industry, we know that is true. We know that potentially 8 out of 10 digital banks will not make it, will fail. But the 2 out of 10 that will make it will be very big and will be very profitable. And at the time, it sounded crazy. I remember saying to people, we're going to build a bank. We're going to have no paper in the bank. We're not going to handle cash at all. Cash will be handled by our retail partners. We will have no middle office. We will have no cash vans. We will have no ATMs. And one person saying to me, it sounds like you're going to build something, but it's not a bank.
Wow.
Because banks have paper, they have cash, they have middle offices, they have all these things. They were seen, and they have branches. But even then, for those of us who understood where technology was going, it was obvious that the world was going to move past that at some point.
Yeah. You've touched on partnerships. You had one with, you mentioned Pick and Pay earlier, and you had hinted on the fact that the model is that you run this service, but then you have these retail partners that kind of execute on them. Given you had that insight early on, how did you approach those partnerships, the mental models of that, especially in the context of emerging markets? How did you get those first set of partnerships? How did value exchange evolve over time?
Partnerships is both a science and an art, and it really is ultimately the art of aligning incentives between different players with different business models and different way of thinking about the world. But where it really started is because we started with financial inclusion as a purpose, wanting to democratize access to finance. For us, digital wasn't the big obsession. The technology wasn't the obsession. The customer and the customer experience was the obsession. And what became very clear to us quite early on in the process is that most people are not going to trust an app on a phone. In fact, when we started, apps on phones weren't a thing yet. We were still doing banking through USSD codes, which few people will remember.
And the customer experience on those were not great.
But it was clear that people weren't going to trust that for a bank. And so that you had to start in people's physical environment and in an environment that they trust. Interestingly, in many places in emerging markets, people trust their local retailer more than they trust their bank. And so we said, why not start where people shop, do business every day? Use that as the trust link to their world, as the physical link. And a very important thing that we did, we deployed kiosks that was basically digital devices for people to open bank accounts and be issued with a personalized debit card. But every kiosk had next to it what we called an ambassador. An ambassador was typically a young person from the local community. The requirement was it had to be somebody who's not more than one taxi drive away from the location of the shop. And that combination of the kiosk, which had very nice lights around it, showed some sort of substance, somebody from the local community who could speak the language that people understood in a way that they were comfortable with, and then partner with the retailer for cash in and cash out, which in some places of the world people don't know, but in Africa we already knew worked. So you would do a cash withdrawal and a cash deposit at the local point. And that was really our party trick, getting that environment to work for the customer and for the retailer. And it required us to be quite humble in our approach to retailers, to really take the time to figure out what works and what doesn't work in a retail store, and what would motivate a retailer to partner with us.
What were some expressions of that humility? Because you make a very important point there on being humble, because I also think there's this world where you come from the external world and you're trying to build technology for people, and your technology should layer human behavior, but you assume you know what they want and you give them something and they don't. Were there any stories or any experiences that highlighted that humility piece of here's what we thought it would be, but it was the complete opposite, or it just wasn't quite?
So many stories like that. And you're right, we all project ourselves into the world. We all think that we are the customer, and we're not. And the other side of humility is respect, is truly respecting the customer. When I hear colleagues saying customers don't know what they're doing, customers are stupid, or customers are that, then we're on the wrong path.
Yeah.
The starting point is true and deep respect for your customer, for their life, for their reality, for the courage it takes your customer to live their life. And we fail at that all the time. All the time we make assumptions, not only about the customer, but also about the retailer and also about the circumstances in the retail store. I'll tell you one story that illustrates the 110 things that can go wrong in a retail store. So we had these kiosks, hundreds of these kiosks out there, and they would perfectly issue their cards through the course of the day. But every morning we came back to those same kiosks. The next morning there would be something wrong with the card issuing. The cards wouldn't issue properly. And we just couldn't figure out what was wrong. So eventually I said to the guys, okay, I want you to stay behind in the store and figure out what happens in the night. And what happened is that the big retailers have these industrial floor cleaners that work in a sort of a circular motion. They zoom around like this and they bump up against the machine and they dislodge the cards in the machine overnight. And it was only through going, okay, we will actually sit in the store at night and see what happens when everyone leaves, that we figured out that this problem existed.
That's very interesting.
And there are hundreds of little lessons like that one learns as you go. One other example I'll use is we thought that we would only attract young people. And in the early days, we had a super user who just used this account in an amazing way. We decided to go and find her. She was in her 70s. Wow. She was illiterate. She had learned the patterns. And she had found a way to use our account in her distribution business and got all her customers signed up onto our account. And I remember we made a story of this customer to remind ourselves never to assume that your customers are and never to underestimate your customers.
I love that.
Love it.
And I want to come back onto the B2B piece. But one thing I'm really curious about is when you started out, less than 20% of transactions were done digitally within South Africa. That's obviously shifted quite significantly today, where over 50% of transactions are now digital. When you were thinking about designing product in the early days, like you went down this path of really focusing on transactions. Most digital banks really think about monetization from a lending perspective, given just how big of a gap there is there. How have you been really intentional about designing products when you decided not to do lending initially, despite the fact that's obviously quite pretty lucrative for most digital banks today? And how has that fed into decision around which products to layer on top since then?
Even today, we have a debate in the business on whether we did the right thing.
But I would say it's obvious. At least this is a pretty good option.
So part of our thinking, starting with transaction banking and savings rather than lending, is that we wanted to build a super low-cost business. And once you get into it, you may not be forced into the discipline of being super cost efficient. So we intentionally said, let's start with a business that only makes the money from transaction banking and savings, and let's build a business that structurally is so low cost that you can make money from that customer. And here was the test. The poorest person in South Africa is what they call a SRD grant recipient. So this is somebody who gets a government grant. They can prove that they have no other income. They get a government grant of 350 Rand, which is 50 US cents a day, roughly. And we said we want to be able to bank that customer profitably without charging the customer unreasonably. It must be so good that the customer will use the account every day. It must be so cheap. And we have now gotten to a point in South Africa where we've got an 11-month payback on a SRD grant recipient.
It's incredible.
Wow.
That was a big reason we started at that end. We started at the transaction banking and savings end, is to build this sort of structural cost advantage into the business. And we've always felt that once you've got that right, now you've also got all the data that you require to really understand the customer and to lend profitably. And then you can build lending on top of it. Okay. And part of the reason, and one of the things we're learning, and most fintechs and digital banks will relate to this statement, when I say that transaction banking and savings DNA, people building wallets and transaction banks, and lending DNA are two quite different DNAs. And learning to go from the one world to the other world is tougher than it sounds. The one thing one develops in this journey is humility. Is you look at what other people do and you think, if we were so good at what we've done, what those guys do should be easy. And then you start working at it and you just realize that nothing's that easy.
Yeah.
There's so many lessons that you still have to learn. So we're very lucky now. In our Series D capital raise, we've had Nubank investing in us. Nubank is one of the most famous digital banks in the world. And one of the reasons we did it is that we are keen to pick up more of that sophisticated lending DNA that we think we will need to make the business truly resilient in the long term.
That's so fascinating because oftentimes a lot of entrepreneurs think that one product is working very well, so expanding into the next product is very straightforward. And actually, there's so many nuances to it and it can be very challenging. You've gone from banking consumers to now banking businesses. I'm very curious what sort of mental models were required in order to serve that different customer segment.
Yeah, interestingly, we have said, at least in this phase of our development, we're going to very much stick to small and micro businesses.
Which in Africa are not quite distinguishable from the individuals.
That's a good point. So we are finding that the transition from consumer to small and micro business in the context of Africa and Southeast Asia, in our Philippines businesses as well as in our South African business, is not that difficult. Okay. And again, what we did when we went into the SME lending business, we actually acquired a business in South Africa by the name of Retail Capital. We had tried to do it ourselves for 2.5 years. And I was saying to my team, we're just not making progress fast enough. And we acquired the Retail Capital business. It was a great acquisition for us. And they brought with them 10 years of experience in lending money, working capital, unsecured working capital loans to small and micro business. That product we have now extended to the Philippines, Vietnam, and Indonesia.
Amazing.
It is our lead product in Indonesia. Now our merchant cash advance product.
Interesting.
Starting with that product now.
Talking of expansion, now you obviously started in South Africa. Now you're operating in Southeast Asia. One thing I find so fascinating is oftentimes when companies think about expansion, they look to their neighbours. But what you've done is expand into Southeast Asia, where there's a lot more similarities in terms of the economy and so on. So could you tell us a little bit about the mental models that you leaned on when you were looking to expand, and why the expansion in Southeast Asia versus the rest of Africa? It seems very intuitive now, but I'm just curious in terms of how that decision was made. What were some of the considerations?
I can talk about this topic for if there's one thing that emerging market founders and entrepreneurs need to think differently, it's about this topic of country expansion. I see people doing two things. They either go to the neighboring country, so geographic proximity, or they think they're going to go to a fancy place like the UK or the US or Europe. They want to go up in the world. And both of those are a mistake. The way we think about it is that picking a country is a little bit like picking a partner. You have to pick the country that is right for you and where the things that you're good at work. And for us, we were very clear that we had developed a particular kind of model, and this is this fiddle crossover model between retail and digital, and that we needed to find markets that were conducive to that particular model. And we said, okay, what are the things that are non-negotiables for us? The one thing is we had to go to countries that would allow us to run an entire bank in the cloud.
Right.
We had to go to countries where we could do end-to-end digital customer onboarding without needing a wet signature on a page. We had to find countries where the regulator was progressive and predictable, so that we knew that if we put $100 million into the country, that money would be well spent. Ideally, we needed to go into markets with well-trusted retailers with good brands. So highly fragmented retail markets would not be fantastic for us. And much of Africa, retail is highly fragmented. We ideally would want to be able to go into a market where you can do 1 or 2 retail deals and cover the entire market with those deals. So if you added those things up and then you went and looked at the whole world, what you found is that Southeast Asia and South and Latin America were actually the best markets for us. And so that it's worth, when a founder or a founding team think about expansion, going, what kind of partnership is the partnership? What are the countries which, in terms of the characteristics of those countries, best suited to us? And that if we did that, we would find many more founders going south to south, going emerging market to emerging market.
So interesting what you've said, because there's something there on knowing who you are and your strengths as a business towards figuring out what's a more natural transition, as opposed to trying to figure out what's good for the world. It may be good for other businesses, but maybe not you. And the second thing that's coming through, because I ran a digital bank as the GM in Nigeria for 3 years, and it was part of a company that had different groups. It was in Latin America at some point, and India turned out to be the best business. Like, it grew so quickly. At some point, the CAC was 0. Like, it was just crazy, because it's exactly to your point. There were theses on which markets made sense, but once you can narrow down to who you are and what you're good at and find markets that have I can already imagine your market expansion playbooks and how you're thinking about which market is right for you and what to toggle in terms of what's more important than others. I'd love to talk about the tension on business model, sustainability, and I guess like margins and all of that, because neobanks are notoriously hard to make profitable. And you, with Tyme, you've done that in just 5 years, yet you're growing aggressively. There's often that tension between like fast growth and profitability. It's if we're growing, no, we can't focus on being profitable, or if we're being profitable, we need to tamper on growth. But that doesn't seem to be the case in this. I would love for you to talk about that. It could be your original sequence of products could have given you a good foundation, but I would love for us to get into that because it's possible to do both. And founders are probably curious as to how.
It's a hellishly difficult problem. I had a black beard before I confronted this problem. The reality is it's very contextual. The speed to profitability and speed to scale will always in some way be in opposition to each other. There will always be some level of tension.
Yeah.
I take Nubank as an example. They took 9 years to become profitable. They were in a market at the time with deep capital markets. They had access to the US capital markets. And they had a business model where they could clearly illustrate their path to profitability. We built our business through COVID, through very tough times in the South African economy. And frankly, our shareholders just didn't have the level of patience that would have been required. But we had to figure out between available capital, the expectations of our shareholders, and the reality of our market. We had to find that Goldilocks zone, not too hot, not too cold, just right. Find that zone where we could continue to attract capital long enough to show that we could run a profitable business. So that ultimately this is quite a healthy tension. FinTech has gone through these hype curves where people go, don't care about profitability, just grow. The challenge with that often is that we fooled ourselves, and I say we as an industry, into believing models are sustainable that were not really sustainable, where we were spending too much money buying market share without a clear path to profitability. And I don't think there's one right answer, but one of the things that founders have to be very mindful of and spend time and energy figuring out is within the context of your business, your shareholders, your capital markets, and capital markets differ from time to time and from market to market. What is that Goldilocks zone for you and for your business? And then to be as disciplined as you can possibly be to make that right trade-off. If I look back, it would have been great if we had more money and we could build more scale and be more patient to profitability. If you're building a business, particularly in Africa, that hand just doesn't get dealt to you.
Yeah.
So you have to think differently.
Yeah.
One of our businesses' claim to fame is that we have one of the lowest CACs in the world. So our cost of acquisition is somewhere between $4 and $5, depending on how hard we press on digital marketing. And outside of China, there are very few banks in the world that can boast that kind of CAC. But it wasn't our genius. It was just the limitation in our resources that forced us to be more innovative in how we thought about the cost of customer onboarding.
I love that.
It's so funny because this insight you probably couldn't get at the moment when it was happening. You probably would be like, we wish we had more money. So in my mind, I'm maybe saying this to founders out there who are probably in that headspace where you're forced to ruthlessly think about how efficient you can be as a business.
Actually, sometimes the things that you think is your worst day at the office, in hindsight, is that blessing that makes your business.
I love that. Now we have a dilemma that's through. So let's shift over the dilemma. Do you want to read it out?
Yeah,
So we've had a founder that's actually...
Yes, so I'm going to read out the dilemma and would love to hear your thoughts. So it says, hi Coen, I'm the founder of a FinTech startup with SaaS and lending components. We raised fast, YC. We also raised over 30 million in total. So our valuation is north of 100 million valuation. And for a while, we were on the classic high growth trajectory. Things were looking good. Then the market shifted. FX movements hit really hard locally. We're growing, but in USD terms, our top line was effectively cut in half. This distorted our metrics and narrative just as we were hitting stride. Now we've built a new product that's showing real promise. It could take us to break even and beyond, but to get there, we still need funding. We've tightened ops, we're trying to raise an inside round, but our current investors, while very supportive, are too exposed to double down. Even a down round wouldn't raise what we need. Here's the harder part. I have a young family. It's not my first startup, and I know what it takes to keep pushing, emotionally, physically, and financially. I believe in the business. I see the opportunity, but I also know I can't keep grinding indefinitely without the right support. So I'm at a genuine crossroads. Do I keep pushing in a capital-constrained market with a clear but uphill path to sustainability, or do I step back, preserve energy, and potentially leave something valuable on the table? I deeply value hearing from your experience. Thanks for reading and truly appreciate any advice.
Oh, that's a tough one.
Yeah.
Wow.
Yeah.
You can pontificate about these moments until you hear somebody describe that situation.
Yeah.
And I was there.
Oh, really?
In COVID, so in 2020, second half of 2020, we were at a point where we absolutely had to raise capital and nobody was funding startups at that point. Over a 6-month period, I pitched to over 250 potential investors
Whoa.
before I got the first yes from an investor. And it's just brutal because every day you get up and every day you're fighting with your back to the wall. And I would say that there is no sort of theoretical easy answer. It's a judgment call that only you as a founder can make in that moment. What happened to us is we diluted a lot more than we would have liked. We ended at the end of that owning a smaller portion of the business than we wanted to own, but the business survived. And it was the right call for us to keep going and to see it through. But I have many friends who have made the other call, who have said, we are no longer throwing good money after bad. We either doing a trade sale to keep the business going, or we are selling the technology. We are doing something else to make it work. What I would say to a founder who really believes that they have a path to sustainability, who really believe in their business, if you believe it, there's somebody else out there who will be convinced by you. You just have to find that person. And if it takes you 200 pitches, then it takes you 200 pitches. But somewhere out there, if you believe there are 8 billion people on earth, there's somebody out there who's willing to be convinced by you. Yeah. So my instinct would be to encourage a founder to keep going. And I know this family thing is a very hard thing because we all have people who depend on us. Yeah. But one way about it, I have 3 daughters. I would rather have them see me lose, but having fought every step of the way, than see me bail out on my dreams. But very tough. Yeah. I don't think in this situation, like I would even pretend, having had my experience, I would pretend to be able to tell somebody what to do.
Yeah.
It's one of those can know what is right for you. Yeah. One of my favorite philosophers, Alain Badiou, wrote a thin little book called Ethics. And he says that our ethical frameworks as individuals get shaped by what he called our loving encounters. Those things that happen in our world that shape how we think about the world. And he said that sin only has 2 forms. Either we forget the loving encounter, we forget why we're doing it, or we lack the courage to act on our memory. And so all I will say to founders in this situation is don't forget why you're doing it, and don't let it be a failure of courage.
I love it. It's super powerful.
Yeah, and it's the glamour of entrepreneurship, but there are hard moments. It's like there are these dark moments that no podcast, nobody can actually tell you what to do. You only can synthesize the information and then have to make a call that's true to you. Yeah. That feels right. That in the same place where the kernel of your idea and your vision and your ambition came from.
And you asked a question earlier that I haven't fully answered, and that was your question about these trade-offs. Yeah. And what the path ends up being. Yeah. And figuring out what trade-offs are are okay and what trade-offs are not okay, again goes to this question of purpose of why you're doing it. Our path has not been a straight path, it's been a winding path. And looking back now, what I realize is that nowhere along the path is there certainty. But what you do need is you need clarity. It's clarity about why you're doing it and clarity about what you are trying to achieve in the end for your customer. And as long as you have that clarity, you can actually live with quite a lot of compromise along the way. And this is also within the context of this founder's dilemma.
Yeah.
Is also what I would say is that every one of us need to figure out for ourselves which compromises within our framework are okay and which compromises actually fundamentally undermines what we are trying to achieve.
Taking it back now to where you are today, one thing that I was really curious about, just thinking about your entire journey, is how you really focused on the bottom of the pyramid, and the whole motivation behind this in the early days was behind financial inclusion. Now you're serving a wider customer base. How have you, because I guess my question is really around how your ambition scales, because oftentimes founders can start off with one thing in mind, but then as things progress and time passes, you realize there's a much bigger opportunity that you can serve. And so how has your view on the opportunity changed since the very early days of Tyme?
All of us mature over time, and we mature in our understanding of the subtleties of the business we're trying to build. In some ways, my initial thinking was a little bit simplistic. You think of yourself as doing financial inclusion, and I'm just going to focus on this segment, which is the hardest thing that you can possibly decide to do. And I've learned a few things over time. The first thing that we've learned is that financial inclusion or democratizing access to finance is not just about poor people. That there are lots of ways in which all of us are in some way financially excluded. One example that I'll mention is that even reasonably wealthy people in emerging markets often don't have access to financial tools to truly allow their money to travel internationally and to invest in hard currencies and so on, which is why so many people in places like Nigeria and South Africa and Philippines invest in cryptocurrencies and stable coins and things like that. So my perspective on what it means to democratize access to finance has broadened. The second thing is that our understanding of the importance of brand and the importance of creating an aspirational brand has evolved and become a lot more sophisticated. Nobody wants to bank with a poor person's bank. No, it makes sense to actually launch a very aspirational brand, even if you want to bank everyone.
Yeah,
It's
but
ironic,
accessible.
isn't it?
Yeah.
We went from South Africa to the Philippines. We went from a cheap and easy to use product positioning to a very aspirational mass affluent positioning. Funnily, we're still banking everyone, but we're now also banking people we didn't bank before, and everyone feels a lot better about banking with us. So I would say that the vision is expanded, but hopefully not in a way that in any way lets down the customers we started out serving on day one.
The core mission.
And the core mission, doesn't forget that core mission.
Yeah.
Now, how have you evolved as a leader from the beginning of having spun out of this consulting project, essentially, to where you are today, operating in multiple markets? We've seen with many other companies, particularly when operating in multiple markets, the importance of culture and maintaining that culture cross-border. Just curious, what are some of the things that you take into consideration as you've grown and expanded as a leader? And for any listeners tuning into this, what advice would you give, particularly on leadership?
Yeah, I would say on leadership, the most important work is your inner work, is working on who you are. And it's a combination of being quite hard on yourself, having high expectations of yourself, but also being kind to yourself and knowing that you cannot be everything to everyone. So I would say for me, the first big lesson is around the team, that understanding your own weaknesses and your own limitations and making sure that you bring in team members who can compensate for those limitations and then respect them. Because sometimes when somebody compensates for your limitations, it's tempting to be dismissive of their perspective. So our chief risk officer, Zimbabwean guy by the name of Joe Sam Watson, he worries And I don't worry. I'm pathologically optimistic. And it sometimes gets to me that Jasam's worrying about this, that, and the other, and phones me up and tells me what he worries about. And I have to remind myself that I brought him in because he has a perspective that I don't have, and that I have to respect that perspective. That for me was an important learning. The other learning for me is about the responsibility that comes with leadership. The difference between a visionary and a charlatan and a fraud. That gap's not as big as people think. That somebody who comes up with a ambitious vision can very easily, if they don't follow through on that vision, and if they don't keep going, in hindsight, judged by victory to have been a fraud. And sometimes what makes the difference is a bit of luck.
Yeah.
But the other piece that is important is taking the job of leadership very seriously. And knowing that you have not only taken yourself and your family along a path, but you've taken investors, colleagues, and that you owe yourself and them to do whatever it takes to see the vision through. And that's why we come all the way back to the story of Sisyphus. Yeah. That sometimes the job is just to keep going every day.
There's so many threads in this conversation for me that I'm like, if we were to explore of it, we would not leave this space. But one thing I wanted to really touch on was on the regulatory piece. As a digital bank, and I know I faced this even then, is when you're innovating in a space that's already quite set in how it considers business models and how it regulates them, you are almost on the verge of both innovation, but then you're also pushing the boundaries of potential regulation. I would love to talk about how you navigated that across markets, because the nuance of Tyme is that you started off being an African bank, but very quickly moved to being a bank for the global south. It's looking like that is what you've now become, because you've replicated your successes with different expressions in different geographies across the world beyond Africa.
Yeah.
And all of these are different regulatory landscapes. So I would love to understand how the early days was with Tyme, and maybe parallels to a founder listening who's building, may not be FinTech, on the verge of innovation, but then also potentially pushing regulation and mental models that they may adopt towards doing that in a way that works.
Yeah, so banking, as you say, very much is this dance between what regulation will require and what technology can do. And there's a saying in law that the law always follows a respectful distance behind technology. And that's a problem, particularly when technology moves as fast as it moves today. And the approach that we've adopted, and there are different strategies, I've seen Revolut take a different tack from our tack. So I don't think there's one strategy. Our strategy is very much to treat the regulator as a partner. So we made a decision quite early on that we will operate fully within the law, within regulations as they stand, and that we will not spend time trying to find shortcuts or trying to find ways around regulation, which meant that we had to essentially befriend the regulators and convince the regulators that we can be a partner with them in the evolution of regulation. Now, to do that, there has to be a reason why the regulator will go on that path with you. A sense, again, lucky in the time in which we built the business, that financial inclusion has been a theme amongst regulators worldwide. And we have been able to convince regulators, and I'll shout out to the South African regulator, to the South African Reserve Bank and the Prudential Authority, and to the Philippines regulator. Both those regulators have proved themselves to be progressive, open-minded, but willing to listen to new ideas around regulation. And that's been very helpful. We have actually made decisions not to go into markets because we weren't convinced that those regulators in those markets were right for what we needed to do. So part of the job on regulation is to be honest enough with yourself not to go places where that's going to be a big problem for you. And sometimes regulation itself can be a reason not to expand into a country or not to do a particular thing. We've made mistakes from time to time, for instance, to press new products ahead of the regulator's readiness and wasting money and time doing so. In hindsight, we should have just given up on those battles earlier. So it's a moving target always. But from our experience, I would say, don't think that you're going to ignore it and get away with it. particularly in financial services.
Yeah.
I love that. I love that. So one question I wanted to ask was this dance between product or distribution. I love this topic because the early stage advice is often build a great product but focus on distribution. Africa is even more important to focus on distribution. And one of the things that Tyme has done, you unlock over 500,000 customers every month, new customers. Like 500,000 every month is a big deal in any context, but you do that consistently and you've been growing quite fast. You're the fastest growing digital bank in South Africa at this point, maybe even top 10 in the world. But that speed is a lot of people per month. And you've really leaned on partnerships to do this. I would love to talk about maybe like how did that come about and are there any growth hacks? But I would love for our audience to be able to take something from that incredible experience with them on balancing like distribution and product and making partnerships work on both ends to stimulate that kind of J-curve growth.
Yeah, such a rich topic.
Yeah.
I would say it's fair to say that we're a distribution first business, not a product first business. In fact, when we started the bank, and this is something I haven't actually told many people, the working name for the project was Ubiquity, because we believed that being everywhere was more important than having a perfect product.
Interesting.
And that the primary problem in financial services is not having a product that's good enough. It's having a product that is close enough to you, whether it's geographically or emotionally, in terms of the ease of the experience and so on. So all our emphasis was actually on bring the product into the life of the customer. And so that this might differ from market to market. There are markets where distribution is solved.
Yeah.
And to some extent, the big app platforms of this world is bringing us closer to a world where distribution to some extent is solved. But for our context, we had to be distribution first. Now, looking at it in hindsight, we also focused a lot on product, particularly on customer experience in the early phases of the product. Looking at it in hindsight, we would say that we could have done better in product. And we certainly did a lot better on our second try. So in South Africa, our Net Promoter Score is in the low 60s. In the Philippines, it's in the high 70s, 78. And it was just a step up from the South African product. And product is not enough. And more people make the mistake of underclubbing distribution than people who make the mistake of underclubbing product.
Yeah.
And certainly if you ask me, why do we have 17 million customers today? I would credit our distribution approach with that.
I love that. It's also market specific. And this is why we also need to be careful with the Silicon Valley tropes being adapted to every market. Because in a market where distribution is pretty much figured out,
Yes.
product then even has much more importance because you're being compared to people who've put a lot of effort because they're there already.
Spot on. And I would go even further to say, I would say everything about your business is context specific. You can only walk from where you stand. And complex systems are in nuanced ways different from each other. And so one of the things we do as we go to new countries, the first thing we do when we want to enter a new country is we try to find the best local partners. Not only people who have good retail distribution, who have deep pockets to help invest, but people who truly love and understand their customers. If you can start with that intimacy, that respect for the customer, that understanding, that passion for the customer in that market, understanding the context in which those customers live, you're already a leg up on people who come with a cookie cutter approach and saying,
True.
We already know all the answers, we're just going to take this product and impose it on a new market.
Yeah, ties back to your earlier point on humility. And it's so funny because that's harder to do than people realize because it's levels to it. You think you know, but if you were to just suspend your opinions for a bit, you see even deeper and you're like, whoa. And I wonder, keep pushing on that. That's really incredible. I would love to hear your thoughts on Bitcoin, cryptocurrency, stable coins, the future of finance as it's called now with the decentralized system. You had hinted a little bit to it earlier, but what are your thoughts? How do you think this is going to evolve in the context of emerging markets?
When you look at that Gartner hype cycle, we've gone through the valley of disillusionment when it comes to crypto and blockchain. And we're starting to understand better what this technology can bring to the world. So speaking for myself, I'm very much a blockchain and crypto bull. I believe there's still a lot of value to be unlocked. The area that I would say is my sort of favorite personal obsession is digital tokenization of assets. That there are whole categories, trillions of dollars worth of assets that can be unlocked through a smart application of digital tokenization. I'm talking about immovable property, movable property, art, all sorts of things. So in terms of cost efficiency, in terms of trust, in terms of security, in terms of resilience, cyber resilience, there's a whole list of good reasons why we should continue to take this technology seriously and continue to experiment away.
Yeah, I love it. And maybe what's on the horizon for Tyme?
So
Going public?
we are entering our third big banking market, which will be Indonesia at the moment. We are expanding our merchant cash advance product into other Southeast Asian markets. Our job in the next, say, 5 years is to not only show that we can make money in South Africa and the Philippines and in Indonesia, but that we can give superior returns on equity to our shareholders. Typical banks will give you a return on equity of somewhere between 8 and 15%. The best digital banks should give return on equity 35% and better, with cost to income ratios under 30%. And so the job is to continue to build that business, to make sure that we build the platform so well that every new market we can enter faster, cheaper, and with less risk. And then once we've got enough data points to show that we can truly build a multi-country digital banking business, that's the time to go to public markets. Watch the space, 2028, 2029, that's when we want to be ready. And depending on the state of the markets, anytime from then on, hopefully we'll be able to go and give more people the opportunity to invest in us.
Exciting. Now, one of the things that we love to do before we wrap up is just ask a quick fire question. So if we would take it right back to the very early days when you started Tyme Bank and you had to whisper one thing in the ear of yourself, what would it be? What would be that one piece of advice that you would give yourself at the very beginning of your journey?
This is going to be way harder than you think, but you are also going to be stronger than you expect.
I love that. Now, next question. Are there any resources, books, podcasts that have been really helpful along your journey building Tyme Bank?
To be frank, they aren't business books. That, again, this comes down to our inner journey. I have found my reading in the space of spirituality, meditation. A writer like Eckhart Tolle, The Power of Now, comes to mind. I found those readings, as well as reading fiction.
Me too.
Very helpful in my journey. And so I would say to founders, read, but don't read just business books. Read other things. Find your inspiration.
Yeah.
I love it.
Tell us what you think of this episode on all of our platforms at the Startup Leap Pod. Do you have a question? Ask us and we'll ask our guests. Go to thestartupleap.io. See you next time.